Hello, this is Ed Butowsky, and welcome to Wealth Transparency. This is our third podcast, and we hope that you are subscribing and enjoying what we are here and offering. Today we have Michelle Connell with Portia Capital Investment Management, Andrew Tang, Chief Investment Officer at Turner, Bill Lane and Lex are from Ethos Financial Group, and I'm Ed Butowsky. I'm Managing Partner at Chapwood Investments, and I'm your moderator. And the goal here is to take storylines that happen either this week or the previous week and explain what people should do with their money as a result of these. These are sometimes hidden headlines that impact your portfolios. So what we try to do is go around the table here and give about 3 to 4 minutes to each person to explain their thoughts on this. So we had the Dow break over 50,000. Bill, is that a significant number, and if so, why?
It's significant in that it allows the people on the exchange to buy different hats and celebrate. There's no value in using the Dow as a price measure. It's fun to talk about, but there's really no economic implications of it.
Okay. Andrew, same question to you. Is 50,000 something that kind of gets your motor going?
Well, I think it's more of a psychological levels. Again, the market, it's showing, it's proving that it's climbing walls of worries. And, every day we have a different headline. Every hour we have a change of events. And so it is no doubt that the market is very resilient. And again, the Dow Jones Industrial Average, again, is 30 companies, like exactly what Bill was saying. So yeah, this is just a psychological level.
And Lex, you want to add on to that?
A whole lot more I can add, as I feel the same way, or as, Pam Bondi said, $50,000.
Yeah, I mean, you hear people get, most lay people just go, wow, it's over 50,000. I remember back when I was at Morgan Stanley, we had a sign that said 10,000 by 2,000. And if you just simply look at doubling the stock market, which if it grows at 10%, it'll double in 7 years. So in 7 years from now, we could be talking about 100,000 on the Dow.
Well, I could double it tomorrow by doing a reverse split of all the shares in the Dow.
Yeah. True.
It's because it has such flawed methodology for calculation.
And Michelle, do you want to add on to this?
I think all the gentlemen have covered it quite nicely, and I agree. It's a psychological accomplishment. It's nice. It does show you, how far we've come in a short period of time, which you referenced, Ed. And just more and more money continues to flow in. And, I'm sure that there are a small number of people in the population that are celebrating, but there's a lot of people that aren't participating at the same time.
Well, speaking of people not participating, China has been a huge supporter of the U.S. debt for many, many years. And recently, because of risk concerns, have pared back in half of what they're buying from the United States. So, Michelle, does that scare you at all?
Not really. I think it sounds horrible, or it sounds worse than it actually is. I think Japan is our number one supporter of our treasury market. China's number two, I think, at 8 or 9%. Yes, it's worrisome. I can understand why they're doing what they're doing, but no. In the short run, maybe it's an issue. In the long term, I think we'll be fine.
Andrew, what's your thoughts on it?
Yeah, I completely agree with Michelle, is that there are many efforts and voices that are out there that are trying to dethrone the dollar or trying to pare back the demand for treasury. But at the end of the day, the U.S. is where the innovation is happening. And in terms of safety, in terms of ability to collect taxes, in terms of ability to showcase growth, there's really no other country in the world that can compare it to the financial system of the United States. So we are the number one capital market in the world. So I have no worries at all.
So is there any fear, Bill, that you're not going to have countries show up to buy our debt?
No, I don't think that's a fear. I think Andrew and Michelle made the point that it's a much deeper market than just the Chinese participation in our treasury market, which this is part of a natural ebb and flow that exists in the currency market. So I would agree not to make too much of it. The price is what the price is on a treasury bond. There is still robust and deep demand at each auction. Whether it comes a percentage point more from another country than China is not a big concern on the scheme of things, unless other countries take a lead and everyone starts to reduce their demand for treasuries. So, and we're certainly not at that situation right now, because of the financial stability that the U.S. offers relative to the rest of the world.
So, Lex, I'm going to throw kind of a curveball at you. Do you think that a lot of these countries, because if they're buying treasuries, and I think 22% of the auction are short term, they're buying treasuries at 3.5%, which is not that great. They can go to Germany and buy and get much higher returns. Do you think that there is some sort of patting on the back, other types of deals that are being done, like you buy my treasuries and we'll do this for you? Do you think there's any kind of side deals going on?
Well, I think you always have to be aware of soft politics when it occurs. But I'd also say relative to just the coupon numbers, it has to be relative to the currency, right, and the exchange rate as well. So keep that in mind. But I think it's underscored here by what Bill, Michelle, and Andrew just said about some of the filling of the void that other countries, if China doesn't buy a percentage, other countries will, and especially other countries that are doing business, maybe are pro-Western, pro-democratic, and pro-business, as the U.S. liquidity and financial markets are. And Bob Michael said it last week from J.P. Morgan. He sort of scoffed at a somewhat similar question to the effect that they're not seeing any real letdown in the buying of U.S. Treasury markets. In fact, they see the stability here, albeit relative with all of the debt. They still see the stability here in the pro-business markets of the United States.
Well, speaking of letdowns, let's talk about social media and the addiction and the platforms that right now there's a lot of controversy on Capitol Hill about the addiction of social media. Do you think that this controversy is going to hurt the earnings of companies like Facebook, / Meta, and Google and Amazon and so on, Michelle?
I think there's a possibility that it could, because the case is currently ongoing or going on, which started last week, and Zuckerberg, I believe, testified yesterday or today. He kind of sloughed off his responsibility, and I think that's an issue. And I think it's also an issue that they're talking specifically about the filters that they put on to Instagram, etc., which hurt juveniles. At the same time, it's really hard to help keep the juveniles off the platforms. I think it's a really sticky problem that they're going to have to come up with a solution other than that. Well, we provide all these things, which could be an issue for young people, but we can't keep them off. I don't think you can have it both ways. So I think you're going to have more parents, et cetera, and people that are responsible for children pushing back and saying, you're going to have to do something.
Yeah, but like my wife said to me this morning when she saw the Zuckerberg feed on the news, she said, but not everybody who's on Instagram and Facebook are committing suicide or murders. There's got to be other factors involved. Andrew, why don't you give us your view on this?
I sure know a thing or two about autocratic, political systems, right? China, for example, is definitely one of the countries that make all the rules. But you keep in mind, this is land of the free. This is the USA of America, okay? So you really can't have too much regulations in terms of limiting the freedom of people using the system. However, I don't think the US firms like Meta and YouTube, they have such a well-known algorithm to keep the users hooked, or any kind of a toxic algo that you're going to discover. I really don't think so. But do we need to set up more guidelines? Absolutely, we can set up guidelines. But in terms of a rule, as long as the companies don't really showcase any ill intent, I think it will be okay. And if there's any kind of fine, it's going to be a drop in the bucket for these mega firms anyway. They're so cash rich, a bill in here, a bill in there. They might as well get fined, and probably will be a non-event, to their balance sheets. But I think it's a good event that the spotlight is shine on the on the issue, so that it will bring more parenting and more focus onto encouraging the kids to do the right things.
Yeah, that's kind of where my wife went. She said it has a lot to do with parenting. Although I will tell you, I probably am addicted to my iPhone. I'll get up for 5 minutes and come back and say, what happened? And I'll look at and see if I have an email. Bill, what are your thoughts on this subject?
Well, I mean, I think you can look at what's going on in Australia, and the government has said, look, you've got to do age verification via facial technologies to ensure that no one under 16 is improperly using your app. I don't think we'll get to quite that level here in the US, but I think there will be significant guardrails that are put up to aid parents. And as a parent, we start out well-intentioned about keeping our kids off of social media, but they're really good at circumventing the rules that might exist with your iPhone or exist with your screen time limits or whatever it might be. So you have to get more from the social media companies and the hardware providers in the toolkit to be able to monitor and keep tabs on this appropriately, because it's a very real issue. Anyone who's seen a teenager with a crooked neck knows why that exists, and it has to be dealt with.
Yeah, I mean, there's no question about it, but it also has, adults have a lot of issues with this as well. It's not just the kids. But so Lex, why don't you give us your input on this?
Well, everyone's covered it quite a bit. I feel it's far deeper than putting this responsibility on the companies themselves. It does harken back to the parenting, the education, the teaching, and it's been a trend for a while now. I do also, there's a theory of paternalistic libertarianism, and I think that's where we sort of need to fall, where it's still giving people the choices, but it's pointing them choices in the right direction. However, look, there's been a degree of Roblox is a great example, and I know it's not pure social media, but it's an interesting platform to, I think, sort of facilitate some of the discussion around moral compass, because I think that's ultimately what some of this comes down to, is recognizing moral compass and recognizing where we as humans have faults, and unfortunately having to have that education much younger, where it's acceptable, where kids are figuring out life, and that's hard to do. But the tech companies do have some responsibility, and like Roblox as an example, it started out as a great platform for kids to be able to not only be playing video games, but building and sharing. So it was a far more appealing platform for parents with their kids and spending time on screens. But now there are games that kids have created, these games that mimic Columbine and Sandy Hook, and like, that's absurd. So we have to find this line where we do have some regulation. We're not stifling, independence and making decisions, but I do think we all have a responsibility for rearing the younger generation in the right way, and in some form or fashion. I don't know how it shakes out, but everyone has a hand in it. Corporate America, as well as everyone at home, right? There's a blend there as a society and community. Have to come to a resolution of some sort.
Yeah. Now, my kids are older. My kids are 31 and 27. But when I go out to dinner and I see a young couple having kids that are on their video games, that just drives me crazy. But if I was a parent today and I just wanted to have a little bit of leisure time, I'd say, go, just play with your game, and just leave me alone. So
that's the easy answer.
Yeah,
it's hard to be a parent. It's I can't stand seeing that ad.
So let's switch gears and talk about Trump's picking the Fed chairman Kevin Warsh and his economic policy direction. I mean, everyone believes that Trump picked him because he would lower interest rates, but when we have a strong economy, and we saw today internally that Ray mentioned that he thinks that interest rates or inflation rate's going to creep back up to about 2.8%. Do you believe that lower interest rates are necessary at this point, Michelle?
No, I don't, for the reason that you just stated. And I'm concerned that we don't have the effect of tariffs all the way baked into our costs. Look at what's happened with memory costs, right? and there's not enough memory chips to be used by technology companies. And I was listening to an economist today on Bloomberg that talked about the fact that you look at AI in the short term is inflationary, which makes sense, right? Because we have all these costs coming into the economy, and how does that affect people? Electric rates are going up, et cetera. But in the long term, hopefully it's deflationary. But in the short term, that could be an issue for us. So I think that in this environment, it's going to be hard to lower interest rates.
Andrew, what are your thoughts about Kevin Warsh and his so-called kind of a given that he's going to lower interest rates?
Yeah, I think interest rates going to head down lower regardless. But Walsh he has characteristics a little bit different. He does want to shrink the balance sheets, right? And so we're seeing that happening behind the scenes. The Fed taking a pause here, I don't think is doing anybody harm right now. But I have to say, it is still very painful for the private sector, especially in the real estate development stage. Again, there's still roughly about $1 to $2 trillion of loans that needs to roll over, and rates are still considerably high. And so, yeah, did rates come down far enough? No. Did it come down soon enough? No. But at the same time, we don't have to lower rates every month. So taking a pause, there's nothing wrong with that. And I think the market is reacting quite positively to that. And so changing of the guards will happen in May, and I think we're going to have an orderly transition.
So, Bill, GDP seems to be the statistic that everyone looks at for the strength of the economy. And if GDP is strong, how can you justify reducing rates on the short end?
Hard to do. Significantly hard to do. You have to have a scenario where credit is frozen or the housing market is frozen, and you need to use your monetary policy lever to unfreeze those markets. Right now, we don't have frozen credit markets. We don't have frozen housing markets. We could argue that part of the housing affordability problem, I would actually see that as much more of a supply problem in the right locations than actually a rate problem. And if you talk to any investor that bought a house in 1980, they will love to tell you about their 18% mortgage that finally allowed them to buy a house. So in the scheme of things, money is still cheap. Economic conditions are actually quite loose. I agree with Andrew that the reduction of the size of the balance sheet is actually of big importance for the long-term viability of the country. Yeah, a cut in near-term interest rates is not really the appropriate medicine right now, and we'd rather save that bullet in the gun for when we do have some true economic weakness and it's necessary to support the economy. To your point, Ed, GDP, yeah, Atlanta said 5% early in January. It's probably going to settle more in the high threes, but that's still a tremendous growth rate that is not in need of further monetary support.
So recently, President Trump said that tariffs were the reason the stock market was going higher, which I think is just absolutely idiotic, because tariffs take away from the earnings of companies. You have to remember that tariffs are a negative to a company because they have to pay the tax or the tariff to the U.S. government. So Lex, how do you justify what Trump said, and can you support that?
No and no. Also, let's be clear, tariffs take away from tax revenues here domestically as well because of the ultimate end collection there too. So while you might get this upfront tariff revenue, it takes away more on the back end. So that being said, I think that there was just a lot more to do with the fact that you had April 2nd last year, and you had all these tariff announcements cause this wild shock to the system, massive drawdown in markets, and then this total change, peel back, right? The agent of chaos saying, oh, no, it's not going to be that bad. And people got excited about it. And then really it was the rate cuts then later in the summer and this idea that we were expecting far greater of a shock to the system in Q3 on the reverberations of tariffs that just never fully materialized in this shocking way. It was gradual. And so I think overall the consumer was able to absorb more of that, but the consumer can only absorb so much of it. And particularly in this K-shaped economy, the lower band of that's really starting to feel it. So it's just one of those egotistical pounding of the chest that is wildly untethered from what's actually happening. Surprising.
So Michelle, if in fact we go to war with Iran, which it looks like a 90% probability according to Axios, what do you think happens to the stock and bond market in the short run and then in the long run?
I hope that probability is wrong. That's scary. I think this is a different scenario versus when we had the situation with with Ukraine and then with Israel, where the stock market didn't care, right? I mean, nothing happened. I think there could be some effect because the fact that Iran is kind of oversees to some degree the Red Sea and the canal in that area where 20% of global oil supplies flows through. That's the issue there. And also the nuclear threat that continually comes out of Iran's leadership. So I think in the short term, yes, I think it could add definitely to volatility and it could push markets down because of the oil threat.
So, Andrew, what's your general feeling about the Iran possible war?
Well, there's a lot to unpack here because Iran does control somewhat of the Straits of Hormuz, and about 20% of the world oil travels through there. So in the intermediate term, it could cause a spike in oil prices. But over the long term or the intermediate term, I think the market will absorb it. We have a consumption that is not at huge level. We still have plenty of inventory. We also have Venezuelan oil coming back online, hopefully soon. But short-term volatility will definitely be present. But overall, I think the market will climb this wall of worry as well. And so we can see the example from Venezuela, even though it is not as huge event as attacking Iran. But there are ample reasons to attack Iran. And I think the neighbors in the Middle East, as well as Israel, it's really wanting the U.S. to do that. They've been wanting it for a while. And if it does affect all the way to a regime change, that's really wishful thinking. But if there is a regime change, I think they'll definitely promote the peace in that particular area. I think a lot of people will be happy. But right now, it's just a show of force, letting them know that, hey, you can't really mess around with the nuclear weapons. And also, you cannot just kill people like that. They reported roughly about 3,000 people died from the protests, but in reality, it's more like 30 to 36,000 people that died. So, I mean, this is a big deal. And I think the U.S. showing their force is justified here, in my opinion.
So, Bill, what final thoughts do you have for the people listening today at the end of this week?
Well, go into the weekend with your Twitter feed live, because that's where you're going to figure out what goes on in Iran in real time. I would also say that the old adage probably holds. You buy when the cannons are firing and you sell when the horns are blaring. So I would not worry about it from a portfolio standpoint. And I agree with a lot of what Andrew said about the importance of this. And the world has basically stood by while 36,000 people have been murdered in the street. And our government is actively advocating in public circles right now this regime change. I also think they're using pressure and the pressure of force to try to get to a diplomatic solution. But the last time Trump said, hey, maybe I'm going to do something in the next 2 weeks, and he did something 3 days later. He said he's maybe going to do something, whether yesterday or today, in the next 10 days. So I think it's likely that something happens, and you need to be steadfast in your conviction, know what you own, understand why you own what you own, and stomach the volatility.
So Lex, in conclusion, do you see any immediate need to change anything in an investment portfolio based on what might happen in Iran?
It depends how I think it depends on your methodology as an investor or a trader. But sure, will there be trading opportunities? I'm sure that they will. Just, from, I think, speaking to more of our clientele, where we're long-term investors about amassing, multi-generational wealth, you have to be steadfast and take a lesson from great grandparents or what have you that have gone through world wars, depressions, etc. where it looked like the world was coming to an end. And this moment in time might be the closest we've seen in a while, right? Where there just seems to be really heavy conflict in a lot of areas. And I think you need to be steadfast on where you're invested, why you're invested, the purpose of that long term. And if you feel that volatility might be, I mean, as it kind of does right now, sort of omnipresent, having a little bit of that dry powder, which should always be part of your strategy, isn't a bad idea, just to be able to take advantage of, like Bill said, when the cannons are firing, to be able to deploy some of that capital. But, we shall see, and we still have to be optimistic in the face of what looks like difficult times.
Well, I want to thank each one of you, and anyone watching this. Please feel free to reach out to any of these professionals. They're all investment advisors, and they do an excellent job at managing money for people. So please don't hesitate to reach out to each one of them or any of them. And I appreciate all of you being on this today. Thank you.
Thank you, Ed.
Thanks,
Well,
Ed.
Thanks, Ed.
Mhm.